Hello, guys. Welcome to this is Austin Black here, and welcome to the very first episode of mitigation series. So, we are going to be having series of episodes for mitigation. So, let's get into it. So, mitigation helps us to know when a zone is going to be used or when a zone is not going to be used. Mitigation also helps us in understanding when we say money transfer and market structure transfer, and it helps us to even understand imbalance, right? What we call FEG sometimes, what we call imbalance. So mitigation helps us to understand these things. But today, for the very first episode, we are going to be talking about primary mitigation. For us to understand mitigation, for primary mitigation, we have to talk about primary ideal situations in price and unideal situation in price. So what is an ideal situation in the market? When we have something like this. An ideal situation in the market is when we have something like this. This is an ideal situation and this is an unideal. Let us start from unideal. This is an unideal situation in the market where what? Where support didn't mitigate resistance. Support doesn't mitigate resistance here. So this is an unideal situation in the market because this support doesn't mitigate resistance. And thereby, an unideal situation in the market is an imbalance, right? Where a support or a resistance that wasn't tapped, where price didn't come to tap into it or didn't come to retest into it, is an imbalance in price. So in this particular scenario, this is an unideal situation in the market where this didn't tap into this. So this is still an imbalance. I will label the imbalance as X. This is still an imbalance because our support didn't mitigate into this particular place. So we still have an imbalance. This low is an unsupported low because there is no support or resistance. There is no support that is actually holding this. So it is an imbalance. It is a liquidity in price. A balanced state, what is a balanced state? A balanced state is one where support mitigated resistance, support mitigated resistance, support mitigated resistance, support mitigated resistance. So this is a balanced market. Balanced. I will just put it BAL. This is a balanced market. So since support mitigated resistance here, then it means there is no liquidity around this particular place. So it means there is no liquidity. So it is safe to now say that an a resistance or a support that has not been mitigated is an imbalance. Let us just even say we have something like this. And price now maybe expanded and continued order flow like this. This particular place, as long as it has not been used, it is automatically what? A structural imbalance. This is automatically a structural imbalance. This is what it simply means. That now leads us to our topic for the night, mitigation. What is mitigation? Mitigation is simply price coming to balance an imbalanced market, right? It is price coming to balance an imbalanced market. What signifies imbalance structurally in the forex market is what? Liquidity. And we have established the fact that a resistance or a support that was not used, that has not been used, an unused, in a layman's language, I can just say an unused resistance, or let us even leave the word resistance or support. Let us even say an unused high or low. When I say unused, it means market has not gotten back to retest, to tap into that particular place. That particular low or high has not sponsored a trade. Since it has not sponsored, when we say sponsor a trade, what do we even mean? This is an unused support, right? It has not, maybe price, let us even say price kept doing something like this or something like this. This one has not sponsored a trade. So automatically, so like we were saying, this particular place is an imbalance and an all mitigation. Why? Because this particular resistance has not been used. So there's a tendency price can come what? Price can come, use it to continue order flow. What has now happened? It now means this now has proper mitigation. So basically, although they are complex ones, they are complex kind of mitigations. In our subsequent episodes of mitigation series, we are going to talk deeply, we are going to look deeply on those particular complex ones. But for the aim of this particular class, we are talking about basic mitigation, primary mitigation. So let us get to the chart now and see chart works, chart examples before we call it a day here. Now, looking at this one from this particular aspect of it, we can see that what can we see here? We can see that we have a high, a low, lower high, and what lower low, and price broke above it and came here. Now you can see that this particular place, now you can see that from this particular support here, this particular support has not been used by price. Since this particular support has not been used, what happened? This particular resistance didn't use it. So there's an on mitigation here, which I call X, right? There's an on mitigation there. Now, let us go to examples of support or resistance that price actually used. Okay. Now, look at this particular place that price actually used. Price actually used this particular place to sell, to create a low, to it used it to sponsor a trade, right? Looking at this particular place, you see that we talked about now every candle is a structure range. What do we say a structure range is? A swing low to a swing high. That means a structure range on a certain time frame is a candle. Every candle is a structure range. Every structure range is a candle. The low of this particular candle is the resistance that was not used, that has not been used. And from here to this particular place can be represented as this, something like this, and something like this. So this and this is an on mitigation, which is this. This and this is an on mitigation. This resistance was not used by price, and that is why we saw that price actually still came back to it. And this particular one too, looking at this particular one, the same thing happened here. This support, there was an on mitigation on this support. From here to this particular support is a non mitigation, and price still came to use this on mitigation to continue order flow. And let us see another example. Let us see. Okay, looking at this particular one too, we still have an on mitigation here. This particular place can be represented as this, created a new high, this, right? So there's an imbalance from here to this particular place. So there's an imbalance from here to this particular low here. Price even filled it. Price filled it. It still didn't use it. Meaning that since it didn't use it, there was still an imbalance from here to even this particular place. So a balanced market is a support or resistance has to be tapped, has to be used, right? Price can use the imbalance, which is the fair value gap, which is that distance from that support to the resistance without tapping it. But that doesn't mean it is a balanced state. A balanced state in price is that it has to tap it very, very well. Now, looking at this particular place, let us look at this. If you look at if you look at this particular place, if you look at this particular place, just like this too, from here to here, just exactly look at what I just spoke about. From here to here is an imbalance state, right? Price use this imbalance without tapping the resistance, because for we to say that a particular structure range is properly mitigated, it means either the support or the last resistance. We are in our subsequent series, we are going to be talking about last resistance, premium resistance, and premium support. There are sometimes price can actually tap maybe a discounted place, but there are still all mitigations there. So in our subsequent meetings, we are going to be talking about that. But looking at this particular one, you see that they used the fair value gap without tapping into this one. So there was still a non-mitigation here. Reason why you saw that price still had to come to this particular place to tap into it. It's just like we saying we have something like this. We have something like this. Then we have something like this, right? Price tapped into this and maybe use it to do a pullback. But that doesn't mean it has properly mitigated it. You can even use it to create a new low. That doesn't mean there's still an imbalance from here to here until what? Until price taps into it before we can say this is a balanced state in price. And that is what price did. Price used here as a balanced state in price and use it to create a new low after this. And when you see there was now a money transfer here, so price reading this. So that is why price used it to create a new low. This particular place, price used it to create a new low. And subsequently, maybe on a certain lower time frame, there was still, I don't think price readed this. I don't think price readed this. I don't think price readed this. Or did it? Let us see. Okay, I think it rated it just a little. Yes. Why did he rate it a little? Simple, right? Because this place has proper mitigation with this, right? I was expecting it to read. I would have been surprised if it didn't, because this had proper mitigation with this. And you can see that price actually rated it a little. It rated it a little and sold. Why? Because there's money transfer. In our second episode, I'm going to be talking about understanding money transfer. So there's money transfer here because it has used this particular place. So power has been transferred down to this particular high. So that's all for now. This is the first episode. I'm sure we have grabbed some things here. So see you on the second and the subsequent episodes of mitigation series. Good luck and good trading.